Robschild. No investment advice. Welcome to the show where we view financial markets through technical analysis, macro financial history, Benjamin Graham's investment philosophy, and of course, crystal ball gazing. Today is Monday, September 23rd, 2024. Today's episode, we're going to start with more on credit spreads, specifically AA bonds. In many previous shows, I've been discussing how surprised I am at the credit spread between junk bonds and U.S. Treasury bonds. The yield difference right now is unusually low, sitting around 3%. And I wanted to bring up AA bonds only because, if you've been following the Intelligent Investor series, we've just gone over a chapter where we discussed how when you have a lower yield on AA bonds, according to Graham himself, it can adjust what is allowable as a decent PE ratio, and when it's really low, it allows for a higher PE ratio. And while the current AA bond yield allows for, in his opinion, a decent valuation, a conservative defensive valuation of stocks to be around a PE ratio of 23. Remember, right now the S&P 500 is 30, so almost 50% higher than that, which is very concerning. But on top of that, if you take a look at the spread between AA bonds and Treasury bonds, you can see that today at 0.52, they are without a doubt unusually tight. When I scroll out of this chart from the Fed showing the yield spread between AA corporate bonds and U.S. Treasury bond yields, you can see most of the time we are usually below 1%, but not typically as low as 0.5%. That only occurs once in a while. As you can see here, as of the most updated version of this chart, September 20th, the spread is 0.52. I mainly wanted to throw this in here just to emphasize how little amount of fear there is in corporate bonds right now. One might correctly argue that you could never get to zero. A Treasury-issued bond is guaranteed by the full faith and credit of the U.S. government, where AA bonds are corporations that can go bankrupt and will sometimes actually go bankrupt. According to this chart, the maximum this had ever gotten within this time range during the financial crisis was almost 5% yield spread. So in other words, AA bonds for a brief while were yielding 5% higher than what Treasury bonds were yielding. Again, these are the times to get into riskier bonds. As long as you're diversified enough, you can make an enormous amount of very safe profits at the bottom of lower grade bond debt. Last thing to tie this together is with the yield spread being only 0.52, whereas typically, it's around 0.8, 0.7 maybe most of the time. If you have a matching PE ratio of 23, as soon as this spread widens even just a little bit, it makes the acceptable defensive investor's stock portfolio at a reasonable price at a lower PE ratio than 23. And right now it's at 30, by the way, just to remember. Later this week, Thursday, GDP, second revision of quarter two. Now this came out, the first revision, it went from an original reading of this of 2.8% and got revised up to 3%. Now, when you're headed into a recession, usually you actually see this go the other way. When they first come out with the GDP, they're like, oh, it's not so bad, and then they revise it and it goes lower. But in this was odd because in my crystal ball reading and all, are very obviously going into a recession, yet this data point suggests otherwise. Now, on Thursday, we will get a second revision. Again, this is like refining the data, getting more information. And so we'll get to see, was the initial more accurate? Was the second revision more accurate? Or was it even stronger than what the second revision had stated earlier? If I were to bet money on this, I'd say that this revision will be revised lower, and this could be something that like breaks the brain of the market and says, things are probably slowing down a little more than we thought here. That would make perfect sense if it worked out that way. After all, why is the Fed cutting aggressively right now? Why did we just have a 50 basis point cut? Friday, PCE data. Remember, this is the Fed favorite inflation gauge. This will be very interesting to see. The next really big data coming out is next Friday, where we have unemployment rate number coming out. Remember, this is what triggered the SOM rule in July, and if the unemployment rate starts going up and up and up, that's when it becomes more and more obvious that, yes, we are indeed headed straight into a recession. A day like next Friday could really actually start a major crash in markets. Obligatory daily reminders: 2-year, 10-year Treasury yield curve was inverted for over 2 years, reversion happening on September 6th. The SOM rule was triggered in July. Recession has started. Unemployment is still low, but it's been going up really fast. That's what the SOM rule does. S&P 500 is at a P/E ratio of 30 without even having major earnings contraction. It is very expensive. There is no intelligent investing going on right now in the S&P 500, in my strong estimation. The rate cutting cycle just began on the 18th with a stronger than normal cut, a 50 basis point cut instead of a typical 25, saying that the Fed is scared here. All of this together, you really don't need a crystal ball to be able to make a strong case for a market crash coming imminently. Now, beyond that crystal ball rating, I'm on the side that the Fed will not cut fast enough to save the economy. While raising rates did not slow inflation down as much as they thought because of the amount of fiscal debt, cutting rates will also have less of an impact than people expect. I'm one of the few people to have and share that perspective. Lynn Allen mentioned it only once, and I think she's back on the other side. On to some charts. While the Federal Reserve themselves, the dot plot came out saying that they were expecting 2 more rate cuts by the end of the year, the Fed funds futures is saying, hold on a second. Actually, we think there is a higher than 75% chance of there being an additional 3 cuts. Look at this. 1 or 2 cuts is priced in for the November meeting, and then another cut is priced in for the December meeting. And in fact, there's even a chance of 4 cuts now with a 27% probability. The Fed says 2 cuts. The market is pricing right now, today, 3 or even possibly 4 cuts. Well, that's all good and dandy, says the S&P 500, sitting at an all-time high today. I've said this on many shows, but Mr. Market, in my estimation, is driving 100 miles an hour the wrong way down the highway. The fuel gauge is completely empty. There's a water bottle that's almost empty, and it doesn't seem to be water in that bottle. So let's see how high this thing can go. I mean, heck, if we can break this parallel trend line, some technicians are saying we're headed to that psychological level of 6,000. Wouldn't that be crazy? For gamblers who want to play that game, have at it, have fun. I won't be joining along for the ride. In fact, I have a little bit of my, tiny bit of my portfolio on the short side of all of this. Notably, triple Qs has been showing an interesting pattern. The last 3 trading days have been just these little tiny doji patterns suggesting that there's a massive battle going on here. And the longer we tightly go sideways after a break like this, the bigger the breakout will be. I am still of the opinion that this is part of a head and shoulders top. For the timing of where we are in the cycle and with what's going on with the Fed cuts and everything that's going on in the world, I would highly suspect for this to collapse in the extreme near future. Not only down to this line here, but breaking the neckline, sending it much, much, much lower. Always remember, you're literally watching a guy with a crystal ball in front of him right now. So take everything with a grain of salt, folks. And, again, as much as I make speculations, I don't use much of my portfolio to bet on these things. I like buying what I think is cheap and holding it. And that's pretty much it. Being bearish, making money on a bearish trend is one of the hardest things to do because markets generally just go up. So, for anyone that is betting on the way down, it's like it's the kind of thing that no matter what, you have to be extremely careful with, especially, considering your position size. My 4 biggest holdings where I'm long, where I think things are undervalued, it's simple. Treasury bonds, so TLT or ZROZ or TMF if you want to get a little crazy. Chinese equities, KWEB is the ticker symbol. Brazilian equities, EWZ or EWZS if you want a little bit more beta. And fourth one, REMX, rare earth metal miners. All seem to be very, very cheap to me compared to everything else out there. I do not have 100% of my portfolio shorting the S&P 500, even though I believe that it will be crashing soon. What I do is I use a tiny bit of money to get put option contracts, and that's it. Moving on, this is the VIX, VIX. This is the fear index. This is how current options contracts are priced. It's cooling off. This doesn't see a lot of fear right now. But if you move over to the VIX futures curve, October is elevated higher than the next 2 months. So the way I see it, smart money has more fear than the rest of the market right now. Speaking of TLT, I noted very recently, sorry about all the scrolling, how we had this trend line here. I thought maybe that would be a buyable dip, and instead we broke below it. On the short term, I'm not too scared of this going down. Either way, I'm holding this until equity valuations make sense compared to the value of treasury bonds. They don't make sense to me right now. So if this goes down, I'm going to keep holding it. I'm not overly bearish on TLT. I'm of the, cautious opinion that, we might be having what's called a fake out to the downside. This is the 30-year treasury yield. As you can see, we're pretty much rejecting on the yield side of this at this line still here. So it's still, the yields seem to be holding down, I guess we can say, at least for the moment. I mentioned in my last show a breakout on silver, so talking about how China is supposedly reopening sort of right now, and how this gave it a pretty strong bid, breaking above this line. It looked pretty bullish, but we went right back below inside this little trend line here. So this is no longer like, you can't count this as a breakout of this, M pattern, double bottom, however you want to look at it, head and shoulders, inverse head and shoulders or whatever. So that's broken now. So silver can really go anywhere from here on a short-term basis. Again, overall, I'm not interested in silver myself. I think from a historical basis, it's overvalued, so I'm not interested in it. I'm a Graham guy. I'm a value guy. I like to find things that seem really cheap to everybody else. I want to buy a lot of it until, it gets more popular, and then I'll sell it. That's sort of how I operate. You'll never see on this show me talking about trying to chase momentum. Most professional traders, and even lots of investors, it's all about momentum. I'm too scared to use momentum, and although it can be extremely profitable, you can potentially, it's possible to get similar results, similar returns by doing the value investing, buying stuff that just seems awfully cheap and being patient with it. If silver gets cheap again, well, I'll let you know on the show. That's all from me and my crystal ball. Hope you enjoyed. Thank you for watching, and see you next time. Robschild.